Hey everyone, today I want to talk about the current interest rate environment in Canada and our options when it comes to saving our hard earned money. So, right now, our inflation rate in Canada is running at 2.5%. You can go to any website to check this. This is for June 2018, I believe. This is the latest figure from the Government of Canada or Statistics Canada. Now, this is fine. What this means is that the prices are increasing at a rate of 2.5% every year. If I spend $100 on groceries last year, today I need $102.50 to buy the same groceries. Now, I'm oversimplifying here, but at the same time, this is what is happening in our economy. We need more and more money to buy the same goods. Now, if I want to invest money to buy the same groceries, if I want to save money, I'm going to get different rates from banks, but I want to TD Bank, for example, to check the rate on a cashable GIC. So this is if I invest for 1 year and I can cash my investment at any time, and I get 0.4% on this rate, on this investment. Scotiabank has another product, 1 year special rate GIC, 2% is offered on this product. So if I invest or I'm trying to save money, I'm going to get 2% on my investment. But to buy groceries, I actually need an extra 2.5%. So what happens here, I make 2%, but the prices went up by 2.5%. What's happening is that I'm losing money. I'm losing my hard earned cash. And I don't like losing money. This is not something that I enjoy. Now, we really have to see what is happening in this economy, what is happening with the rates, right? What the central bank is doing, they're keeping the rates low. They're keeping our interest rates low, and banks cannot pay you as much money on your investments. This is because of the central bank. Bank may take fees, may charge fees depending on different investments, which is absolutely normal because they have to cover building expenses and they need to cover employee costs, software costs. This is fine. So they take a little bit of a spread, but when your interest rate is below the rate of inflation, savers like me get pissed, right? Because we start losing money. Furthermore, if you invest in a regular savings account, then the government will tax you on your return. So let's say you make $2 from your $100. Now you actually have to report it on your income tax return. The government will take more money from you because you usually have to pay taxes on your income, depending on your financial situation. But this is what usually happens. So we actually we'll lose more money than we talked about just now. So why is our government doing this? It's actually not our government, but most central banks are doing this. I checked the US data and I checked Australia as well as other central banks, and most central banks are keeping the interest rates below the inflation rate. Now, the banks are telling us that they're trying to stimulate the economy. Now, what happens here is if their interest rate is kept low, then people will borrow money for education or housing or building a house or other project, and then they will employ other people, and then those people will get income and invest more, and the cycle goes on and on and on. However, if there's too much investment and savings, if everyone has too much money on their hands, then the prices start going up and savers start losing money. And savers once again get pissed. So the other reason that alternative reason that people talk about why is the central bank doing this is to inflate out of debt. What happened in Canada as well as other countries, our debt levels have increased. So this is just a chart that is showing percentage of government debt as a percent of our GDP, of our gross domestic product, which basically means all the goods and services that they produce in the economy. Once again, it's an oversimplification, but this is everything that we produce and sell, right? This is just a metric showing, well, how much debt do we actually have compared to our goods and services that we produce in the economy? And right now, it's peaking at one of the highs, right? It peaked before in 1993, but right now it's pretty high. So what happens? How do I actually inflate out of debt as a central bank? If I run inflation, if I run inflation in the economy as a central bank, if prices are increasing, what's happening is salaries are going up. Hopefully, not yet, but I don't know about your salary. Mine is not, but let's say salaries are going up. Prices of groceries are going up. Every price is going up. So the government will start collecting more revenue from you because you're making more paper money. However, the debt level is probably staying the same, right? So let's say the government borrowed $100 last year. In today's environment, it's still $100. So now what happened is your salary went up, but the debt level stayed the same. Housing prices went up. Grocery prices went up, but not debt that was issued in the past. And what we can do now as a government, a central bank, we can now use this extra revenue to pay off the debt, right? And you may argue that's good for everyone, but it's not good for people who are trying to save money and who are trying to retire early, who are trying to take care of their offspring and so on and so forth, right? So that's not good for those people. But if you borrow money, like if you buy a house, if you have student loans, you may not be in favor of increasing interest rates. You may not be in favor. So borrowers win and savers lose in this environment. So depending on which side you're on, you will make that decision for yourself. So, in particular for savers, what do you do in this environment as a saver, right? And I think we only have a few options as savers. If you have extra cash that you can invest, extra money somewhere else. So, option number one, invest in a low interest rate product which is safe and lose money, right? You're losing money once again because the inflation is higher than your saving rate. Option number two, invest in a risky asset like a stock market or real estate or REITs, real estate investment trusts or royalty trusts. So some of the royalty trusts right now are paying 7% depending on the trusts, but you can invest in those and hopefully beat inflation over the long term. Those trusts though, they fluctuate a lot, and the stock market as well. As you know, in January this year, the stock market dropped 8 to 10% just in a few weeks. So if you're taking a long view for your investments and you don't care, one of the options here is just to invest in risky assets. If you want a balanced portfolio, and most of us have balanced portfolios, we're going to lose money on our fixed income, right? And this is what's happening. And I don't really see any other options here, either risky assets or assets that pay no money and you lose money. You may also want to find currencies that have real return. So in New Zealand, potentially there's a real return situation. If you look at New Zealand, their rate of interest is actually higher than the rate of inflation, but it could be a temporary measure, and it's pretty hard to invest in New Zealand dollars. There is just nothing offered in the Canadian market that you can use and make money in New Zealand dollars, plus there's a currency risk. It's the whole other issue that you have to deal with. But we live in Canada and we want to save. Right now, we cannot do it with a short-term interest. We have to go into risky assets. Some of us cannot take risk, and this is a problem. So you have to decide for yourself. I cannot advise because every situation is different. People have different assets. Some people borrow, some people save. Some people have 20 years to retirement. Some people have 40 years. Some people have 1 year. So speak to your financial advisor about that. But I just wanted to make sure that, not make sure, but I wanted to discuss the issue of inflation and what the central banks are doing at this stage. And that I'm sure some of you, at least some of you, feel this pain where we're losing our hard-earned money and there's nothing we can do about it. That's it for today's video, and speak to you soon.